Well, good morning. I think it's time to get started for the deep dive this morning. I want to welcome everybody that joins us each Monday morning as we start the week this way, talking about the most interesting or the most relevant topics in real estate today. And we're going to do that this morning. If you saw the announcement or the email, we're going to be talking about interest rates, one of the impacts of the conflict in the Ukraine. We'll talk about that and the effect on real estate this morning. But as always, let us know where you are watching from. Let us know how you're doing. I'll follow along here with everybody on here. Joanne, see you there from Wisconsin. Glad to have you on. See you on many times on the deep dive. So glad for everybody that supports this and hops on Monday mornings. You know, I think one of the keys to what we do as professionals is being educated in the market. You know, we always say the most educated agent wins, and that's certainly true today. One thing I'll talk about at the end of this webinar, I'll give you a way to register for it, is tomorrow we're going to do KCM Spring Market Update as a webinar, and I'll show you how to register for that. But if you haven't registered, you're going to want to hop on that. And we'll be talking about everything that's relevant in the housing market right now. Veronica, see you there from Chicago. Glad to have you on. Charlene, happy Monday to you from Fairfax, Virginia. We're right down the road in Richmond. So Stephanie, see you there from Michigan. So many folks from all over the country joining. Jamie, good to see you there from the Keys and folks all over. Let us know where you're watching from. We're grateful for you and the investment in time that you make each Monday morning, whether this is your first deep dive or you've been doing it with us for the last 2 years, the investment to be the knowledge broker for the market that you serve. So let's talk about some interest rates conversation. You know, if you saw the update, I just mentioned the video that I recorded that we're going to talk about the impact to interest rates this morning. You know, I started off last week talking just a bit about, you know, the conflict in the Ukraine, the Russian invasion there. Our hearts go out to those that are impacted, and gosh, we want to see this resolved quickly and continue to hope and pray for that. You know, as agents in the real estate business, I think there are many that are wondering, okay, how could this affect home prices? What could be the impact? And that's our job right now, is to be the knowledge brokers for this information to the clients, the buyers and sellers that we're working with. And that's what we can control right now. We can control that, the information that we give to people and help maybe alleviate some of the fears they have, give them the truth about what's happening in the market. You know, we oftentimes say there's not good news or bad news, it's just the news. And we want to be able to deliver that to people. So, you know, if you remember last week, I talked about the impact likely would be some sort of reprieve on the rising interest rates in this country. And we saw exactly that. Now, I want to give you that information. I want to give you everything that you need to be educated on this topic. And I think it's a great topic to write a social post on. You can use a KCM social post for it. Maybe you record a video for it and get this information out there. But I'll share my screen and we'll kind of kick this off with the weekly update from Freddie Mac. They say this: geopolitical tensions caused U.S. Treasury yields to recede this week as investors move to the safety of bonds, leading to a drop in mortgage rates. While inflationary pressures remain, the cascading impact of the war in Ukraine have created market uncertainty. Consequently, rates are expected to stay low in the short term, but will likely increase in the coming months. One of the things that I pull away from that, you see there the bottom corner, the orange number there, the average 30-year fixed in this country now at 3.76. You know, just a few weeks ago, right at 4%. So seeing a little bit of relief off of that. Three things about this that I want to draw your attention to. First, they reference the U.S. Treasury yield. Remember, if you've been following the deep dive, you're a KCM member, you're well prepared to understand interest rates follow the 10-year Treasury, and I'll get into that in just a minute. That's what we want to start to look at. Second, market uncertainty. The thing this has caused is many people to go, we don't know what's going to happen. These markets do not like uncertainty. What you're looking for in this, if you want to sort of read the tea leaves, is when does this become something certain? And certainly it's, you know, I don't want to talk about that and ignore the human toll and those that are suffering in this, because that's critical critically important, and we want them to make it through this. The Ukrainian people certainly want them to make this through this safely. But as this is uncertain right now, what's going to happen, how long, impact, all of those uncertainties lead to these lower rates. Third thing, I'm sorry, that's important about here is the last sentence here. Rates are expected to stay low in the short term. I would act as if this is a window. You're working with buyers. This is a window. I would not count on these lower rates lasting. If anything, these tensions abroad have halted the rise in interest rates. So the question is, how long do they halt the rise for? The Fed meeting later this month has certainly nodded their head to a raise in the Fed fund rates. They do not control interest rates. That is not the interest rate in this country that's charged for borrowing to buy a home, but they do influence interest rates. But we want to start to look at what's happening here with market uncertainty. We're going to look at the 10-year treasury, and we're going to say, okay, this is not going to be something that's going to hang around forever. Okay. So if we look at this graphically, this is what this starts to look like. This goes all the way back. This graph of the 30-year fixed interest rate goes back to the beginning of 2020. We know we dipped down through the pandemic as the Fed influenced rates lower. And then we start to come back up and come out of January. We started at January at around 3.1% as the average 30-year fixed, get close to right there at 4%. And then we have this reprieve, this tension, this uncertainty in Ukraine leading to 3.76 for the average interest rate. I would use this graphic. I would use this information to go out and talk about a few things. One, where we started the year. And you've heard me maybe say this before. I would take the average loan amount in the market that you're in, and I would calculate a payment at 3.1%. That's where we were at January 1st. I would then go in and I'd calculate where are we at today. 3.76, according here to Freddie Mac, as of last Thursday. Where do you think we're going? Is that 4? Is that 4.5%? That gives perspective to the rising interest rate environment to those that are thinking about buying today. That's the topic that I would be talking about in this particular subject is what is the cost to someone that is thinking about buying, in the process of buying, trying to secure a home so they can lock in that interest rate. I know there are a lot of people in that boat right now. But I mentioned the 10-year treasury. That's what we want to watch if you want to say, okay, what's going to happen coming out of here? And I'll give you a quote that came out from NAR. Following the trend of the 10-year treasury yield, mortgage rates will likely fall, remaining below 3.9% this week, which they're below that. However, expect mortgage rates to rise later this month. Second time we're hearing that, as the Fed will raise interest rates. Again, Fed doesn't control interest rates. They control the Fed funds rate. But you have this market where many people are saying, don't expect this to last. Okay. Don't expect this to hang around. As soon as this becomes certain, then we'll know. Certainly don't have a crystal ball. I can't tell you if that's next week or that's longer down the road, but I would act as if this is a short-term reprieve in the rise in rates. Odetta Cushy from First American says the 10-year treasury yield is down, likely in response to the worsening Russian-Ukrainian conflict, and mortgage rates may follow suit. So let's look at the 10-year treasury yield. I want to show you kind of what's happening there. Certainly not suggesting that everybody on the call that's maybe an agent needs to become fluent and an expert in the 10-year treasury rate. I want to show it to you. It's a great time to have a trusted mortgage partner, lender partner on your side. But stay connected to KCM because we've got your back on this. We're going to continue to follow it and give you the latest information. But this is the 10-year treasury yield, up until the end of last week. This was actually how we closed the market on Thursday. And you see kind of this peak in the 10-year treasury, and then just what Odetta just talked about, the yield starting to come down there. 1.72 on the 1st of March, 1.84 thereafter. And so we're going to continue to watch this at KCM, but this is the leading indicator for the 30-year fixed rate in this country. Why is that? I'll bring back a slide that, again, you've been following the deep dive, you've been a KCM member, you're well versed in, and you certainly are prepared for this conversation, but it's this one right now, this one right here. for the last 50 years, the 30-year mortgage rate has moved in unison with the 10-year treasury rate. So if you want to know what's going to happen with mortgage rates, you need to look at the 10-year treasury. Let's look at the 10-year treasury. We peaked up and we saw this a little bit of reprieve in rates, exactly what we've talked about, we've been talking about as we look at the 10-year treasury. That's what you want to pay attention to as you look at rates, okay? I think using this slide again, maybe the slide previous in the 10-year treasury, as you talk to people, maybe you have this on your phone as those are wondering what's happening right now with rates. Let's keep this conversation going. I'll give you just a couple of more slides here to give you perspective on this rate. George Ratu at Realtor.com, with a slight retreat in interest rates this week, saw an advance in housing market activity as buyers sought to find the right home. So many people saying, okay, now is the time. We see a little bit of a relief, maybe in the rise in interest rates, heading up, and we're going to try to make something happen. I think they're seeing a lot of activity right now, certainly across the country, coming out, COVID rates declining, coming out of the winter months of the Omicron variant. Likely to see more people listing, likely to see more people saying, hey, how do I take advantage of this market? And our job is to be there with the facts for them to help them make the most wise decision they can make. Now, as we see this advanced activity, I want to give you perspective on where we sit right now in the 30-year fixed. You take a rate of 3.76% we just talked about. This is what this looks like compared to decades going all the way back to the 70s. The average interest rate in this country on a 30-year fixed by decade, the height there you see in the 80s, over 12%. Most recently here in the 10s, just over 4%. Now, I think this rate's going to go up, and I don't think we're always going to be below the 10s. I'm not suggesting that. What I am suggesting is we sit in a very, very good interest rate environment in this country, even as rates rise, still very, very good in the outlook for financing for a home today. So again, another graphic to keep on your phone, just to give perspective, get to educate the buyers and the sellers right now that you're working with on what's happening in the market. I'll end with this one quote here, and then I'll pause for some questions. NerdWallet, mortgage rates fell this week as investors sought safety by buying mortgage bonds. Term you'll hear a lot of time is the flight to safety, money moving out of the stock market into the bond market. This decline in rates is temporary. It's the third time we've heard that today, because the Federal Reserve will start its rate raising campaign in earnest in the middle of the month. So expect this to be temporary. Watch the 10-year treasury if you want to see what's happening, because for the last 50 years, that is what has been the leading indicator for the 30-year fixed in this country. And be out there and take action with this knowledge. There's two things you have to do. You have to have the knowledge, then you have to go take action with it. Record a video with it, put it out on social media, one of these graphics. If you're a KCM member, you have access to KCM social graphics. And if you're not, start a free 14-day trial. We'd love to have you start that and just check everything out. Well, listen, we'll wrap on that. If you do have questions, you can always send them to us. We're here to answer those for you, but hope you have a great Monday. Thanks for always joining us in the Deep Dive to get your week started off this week, and we'll see you back next week. Take care.